let's jump right into this explainer. If you're rigorously analyzing businesses, financial portals usually just hit you with a wall of dense metrics, right? Ratios, percentages, it can make anyone's eyes glaze over. But today, we're taking a value investor's lens to translate that raw data into a clear narrative. We're breaking down the financial engine of travelers companies, ticker symbol TRV, to see exactly how a seemingly quiet insurance stalwart builds serious wealth.
Before we dig into the fundamentals, we have to talk about this staggering number, 949.63%. That is TRV's total return over the last 20 years. Just think about that for a second. If you'd parked your capital there 2 decades ago, you'd be looking at nearly 10 times your original investment. In a market that's constantly distracted by flashy tech narratives, a traditional insurance business delivering nearly 1,000% return, yeah, that's something we absolutely have to pay attention to.
So how exactly did they do it? Today, we're going to use a strict financial funnel approach. We'll hit 4 key areas. First, historical returns. Second, the profit engine. Third, shareholder rewards. And finally, valuation and price.
Section 1. Historical returns, a legacy of compounding.
Starting at the top of our funnel, we need to know, was that massive 20-year return just a lucky break? Well, clearly it wasn't. TRV is a consistent, decades-long compounding machine. Over 5 years, your money doubles with a 106% return. 10 years, it triples at 225%. 15 years brings you up 567%, right up to that massive 949% mark at 20 years. That is an average annual compound growth rate of over 12% across 2 decades. It's the very definition of a durable, wealth-building stalwart.
Section 2. The profit engine, unpacking operational efficiency. Okay, we know stock prices follow fundamentals over the long term. So, moving into the engine room, the crucial takeaway here is TRV's accelerating momentum. Just look at how the net income growth jumps. It goes from an already solid 21.8% over a 5-year average to nearly 40% over 3 years, up to a massive 78% in the trailing 12 months. And earnings per share? That metric absolutely explodes to over 357% in the trailing 12 months. The business isn't just growing, its profitability is accelerating at a breathtaking pace.
And what's really impressive is they're doing this with incredible capital efficiency. Take their return on equity. The 3-year average sits at a very respectable 15.38%, but the current ROE? It's 23.60%. That means for every dollar of equity, they are generating over 23 cents in profit. That's a 53% surge over historical averages, proving management is extracting significantly more value out of their equity base today.
We see that exact same operational strength when we look at return on invested capital. Now, ROIC is a critical metric for us because it reveals how effectively a business uses its capital to generate profits. Their current rate of 5.62% represents a more than 66% improvement over their 5-year average of 3.37%. It's just another clear signal that the underlying mechanics of Traveler's business model are becoming increasingly efficient.
All of this top-tier efficiency translates directly into a highly profitable bottom line, giving them a current net profit margin of 12.03%. In the insurance industry, keeping 12 cents of pure profit on every dollar of revenue is a remarkably strong position. It shows that despite economic headwinds or claims payouts, TRV maintains incredibly strict discipline, keeping this metric well above historical norms. Section 3. Shareholder rewards, cash flow, and dividends.
A highly profitable company is fantastic, but as an owner, you want to know how it returns cold, hard cash to you. That profit engine we just broke down generated a staggering $11.4 billion in trailing 12-month free cash flow. Free cash flow is the lifeblood of a business, right? It's the actual owner earnings left over after paying expenses and maintaining assets. Having over $11 billion provides massive flexibility for management to weather storms, buy back stock, or pay robust dividends.
And because of that massive cash generation, TRV is a true dividend powerhouse. Now, a 1.70% yield might seem modest at first glance, but context is everything. They have increased this dividend for 21 consecutive years. But here's the best part, the safety. Their payout ratio is only 13.21% of earnings, and it consumes an incredibly low 8.45% of their free cash flow. This dividend is virtually bulletproof. They could multiply their payout tomorrow and still have billions left over.
Section 4. Valuation and price. Is the price right?
We've seen the growth, we've seen the safety, but the final crucial step in our funnel is valuation. Before we hit the numbers, let's ground ourselves in the core principle of value investing, the margin of safety. This is your financial cushion. It's the gap between what a stock is actually worth, its intrinsic value, and what it costs to buy today. You always want a wide margin of safety to protect your downside. When we look at the actual valuation, there is a massive disconnect in scale. We have a current trading price of roughly $295 compared to a calculated fair value price of nearly $993. Based on discounted free cash flow models from our source data, this reveals a monumental 70.29% margin of safety. The market is offering this stock at a massive discount to the actual cash it's expected to generate.
And we see this exact same theme of undervaluation when we check traditional pricing multiples. Their current PE ratio sits at just 8.78. That means the stock is trading at a 33% discount to its own 5-year historical average of 13.12. Furthermore, the PEG ratio, which measures price relative to earnings growth, sits at a near 0.11. A PEG under 1 is generally considered undervalued, so a 0.11 means you are paying practically nothing for this company's future earnings growth.
So what does this all mean? We've poured the data through the funnel. We've uncovered a company with a 949% return over 2 decades, accelerating net income, highly efficient capital allocation, an incredibly safe dividend, and a valuation sitting at a steep discount to fair value. As we wrap up this explainer, I'll leave you with this provocative question. In a market full of noise and overhyped trends, does a quiet compounding machine with a 70% margin of safety justify a place on your radar? Take a look at the data, weigh the valuation, and decide for yourself.